Do landlords need to be held accountable? We're going to be discussing one particular bill that's worked its way through the General Assembly in Indiana, just passed the House, that aims to do just that, holding landlords accountable. May not be the end of the world, though. We're going to be discussing that. But other than that, more local story, we've got a lot of macro issues and reports to discuss. From the jobs report from the Bureau of Labor Statistics, articles from Globe Street, and Yahoo Finance. Also just talking about, where are we going in this market? It's 2023. The multifamily industry is still frosty out there. We had an exciting meeting out in Las Vegas last week at the National Multifamily Housing Council. We're going to be getting into all of that and more, so stick around for the Gray Report. So if you're a multifamily investor, active, passive, just curious, this is the YouTube show for you. All right, let's get into it. Back to the Gray Report, Director of Communications and Marketing here at Gray Capital. Matt Bosnagel joins us once again, as he does every single week, putting the whole show together, making it all work. Train's running on time, more or less. Matt, I was looking at where the time is. That's mostly my fault. Matt, how's it going? How's the week?
Pretty good.
How's your week been?
Pretty good. It's been nice. It hasn't been scary at all. Yeah. My assessment of the news is that a little more uncertainty, but the uncertainty is almost like upside uncertainty. It's like we're getting some good news. When's the bad news coming?
Or when we're a little afraid to talk about it being good.
Yeah, exactly. Exactly.
Soon.
Yeah, I'm trained.
In the public market, it's like, is this another bear market rally? Just, enthusiasm. What's the next, shoe that's going to drop, though?
Yeah.
I think there's a sense that we are definitely not out of the woods, but I think people are starting to see some light at the end of the tunnel, maybe. Now, it could be complete false signs, but there's some renewed optimism where, again, a month or so ago, the idea of a soft landing, whatever that means, is just not an option. And now more and more people are trying to say, it looks like things may work out relatively okay. It's not going to be, that bad, but there's also, a list of possibilities that things could turn south pretty quickly.
So with all of this kind of general perception of the economy, we're getting this trickle of maybe good news, but it could be bad. What was the attitude at NMHC in terms of the economy and then maybe multifamily fundamentals?
Yeah.
Do they think that we're going to be dipping into a recession where people are going to stop paying rent, or where rent growth is really going to start to tank? Or are people's thoughts of no, the underlying thing is great, we're just waiting on deals?
It's a little bit of a combination of all of that with more emphasis on some areas and less on the others. The fundamentals were the least of concern, talking to just about everyone there. There was really no one of the opinion that, multifamily, at least in the kind of medium and long term, have any issues. Now, certainly there's concerns in certain markets with new supply coming online. Markets like Phoenix, markets across the Sun Belt, Dallas, Austin, Huntsville, Charlotte, just to name a few. But it's up for debate about how much of a headwind that's going to bring to those markets and for how long. Most people perceive it as a short-term headwind, and partially it's because. And this leads to just more confidence, again, in the long-term approach is there's a lot of supply that's in the pipeline right now to be delivered this year, next year. But, end of, getting into 25, the pipeline really is thinning out. Yeah. And there's not that much appetite today for new development. There's not nearly as much appetite.
Yeah.
Development is hard to pencil right now. I saw a quote of, why am I going to build to a... if I can build to a 6 cap, 6.5 cap, but I can now buy at a 5 and 5.5 cap.
Yes.
So it's you can get a little bit more return developing if prices stay relatively stable and cap rates remain relatively, prices and everything costs. But if we learned anything, they haven't. Now they're becoming much more reasonable than they were. Lumber and steel have come down, but what the environment you're selling into is very uncertain. And investors would much rather prefer the kind of the risk profile of buying an existing asset that is throwing off cash at a decent basis below replacement cost. Right now, I think that what's in favor is not big value add deals. Again, just because of getting the labor, getting the supplies. and it's more of what can you find that is at a good price that throws off cash today in a solid market. And there's a ton of demand for that. Like, there's so much capital right now. I mean, everyone was talking about that's what everyone wants to buy. More interest in the Midwest than there has been in the past. I believe we had Carl Whitaker, in some of his comments about NMHC saying, there was actually a lot more talk about the Midwest because of its stability than there has been in previous years. Saying that maybe you're going to give up some of your upside, but you're going to limit a lot of your downside by looking at some Midwestern markets. A lot of people are ready for some distress. There are a lot more people that are hunting for those distressed opportunities than there are actual distressed opportunities now. Looking at loan maturities, talking to folks in the debt markets, capital markets. We're going to be seeing more of that near the end of this year into 2024, although we're still already starting to see some of the pains. We're hearing bits and pieces. With rates rising, not only is your interest rate that you're paying increasing, so your debt service is like doubled, and you didn't underwrite that.
Yeah.
A lot of these owners also were forecasting, huge double-digit rent growth, like 20, 30% in some of these markets. They're not getting that rent growth. Their interest payments are going up substantially, but also their cap payments, their escrows, because if you buy a floating rate loan, or you take out a floating rate loan, with the agencies, you have to buy an interest rate cap that costs money, and you also have to, and it only lasts for 2 or 3 years, or a couple of years. You also have to set aside money in an escrow to replace that cap when it expires 2 to 3 years later. And as the price of those caps have increased, as interest rates have increased, and they're looking at the forward curve, what you have to escrow has also increased. So they're getting hit from 3 different ways. Paying more debt service, paying more escrows, but also missing out on the rent growth that they were needing for their business plan. A lot of these folks are purchase these assets on short-term bridge loans, 2 years. They're a year into that. Maybe they're 16 months into that. Yeah. And so now a couple of things can happen. Either they can, in some cases, they have gotten the rent growth, or they've got just so much cash in reserve that they can refinance and they're all right. But that all really depends on where they bought, how they bought. Yeah. If they overpaid or not.
Do you want to start with the Globe Street article, because it folds really well with this discussion, and I'm saying this because that's one of the things that I noted in your discussions of the NMHC and in a lot of the recaps and just in a lot of the conversations is this hunt for distressed properties. And I'll say I encountered this article. This is where you'll find distress in multifamily is the headline. I remember it when it was at the bottom of the trending articles, and it zoomed up to the top. It's the most clicked article of yesterday, at least.
On the Gray Report?
No, not on the Gray Report, but on Globe Street. It went from not clicked, and I will give away. It's not much of a spoiler to say this. It doesn't really tell you where you're going to find distress in multifamily. It says what Spencer says. There are people that bought at the wrong cap rates. There are with floating rate debt that they're going to squeezed on. My thing is what kind of concessions, or how are the banks going to be willing to work with that?
That was a question I asked Paul Fiorella, who was on with us, and just his opinion, because he's covered capital markets, the mortgage industry, and I was asking a lot of the lenders at NMHC that we know pretty well their thoughts, and he says they're already what they were telling me is they're already having some of these conversations with borrowers who have maturities coming up, and it's I think it's very relationship based. Yeah. And it's situational based, and how that borrower has been performing, and how they're communicating, when they're communicating. If you have a loan maturing in 6 months, and you have the conversation of here's our plan, this is where we're at. Yeah. This is what we're proposing. There's a high likelihood the bank is going to work with you. They don't want to take keys. They don't want to manage properties, but they will if they have to. And but if your loan maturity is in a month, and you haven't communicated, and you're you need to give me an extension or restructure my loan, there's going to be less appetite for that.
Well, and what I think is and this may be a bad analogy, but I had student loans, and they were very willing to just give me a deferment, and they're like, yeah, well, you'll pay later. You're going to pay a little more,
and that's what happened in COVID. And it's what you're talking about. I mean, that there was a lot of what was the term that
moratorium.
Well, not the eviction moratorium, but basically, for like residential mortgages, like you could go into forbearance,
yes,
and you could basically not pay, and then you basically kind of work it out with the bank, at the end of the forbearance, and that happened, and they kind of worked it out, but what I don't know is that, that was like a national program, and I don't know I think that there will be some lenders that will possibly maybe offer similar programs, so they're kind of used to it now, but. I don't see this as immediately rising up to the level of concern where, the federal government does much. Now, maybe the FHA, because Fannie and Freddie are over 50% of the loan volumes, and they're quasi-governmental entity.
Yeah.
And if they're basically governed by the FHA, and so it's how much distress is there going to be, and who is it? Because if it's only just a very local and loud, we hear about it, but it's only a pretty small percentage, and it's not like a systemic risk to the market. It may be sorry guys, you made a bad business decision, and I think that'd probably be the right decision as a national policy, what the government's going to do. Individual banks, I think they should have the freedom on a case by case basis, but I think it would set up. It sets a very bad precedent. And
my thought was, and I said this before, if there was enough distress in the market to meaningfully impact it, because I think the implication is we're waiting for these distressed properties to finally get the gears moving to create to alleviate this bid-ask spread in the sluggish market.
Exactly, but the market has to move, and we kind of need these properties to actually go into distress for the market to function, and getting in the way really is going to just hamper the market for years to come.
But my point about that though is I don't know if we're going to have enough distress such that distress itself will be the mover that kind of grinds things, or that gets things moving again. Because if we had that level of distress, it'd be like a national tragedy. I don't think
it'd be another. It could be another. Housing crisis. Another financial crisis, because think about, again, multifamily. It's a big industry, not as big as obviously the single family home market, but it's a big industry, and there's a lot of derivative products and loan products and mortgage-backed securities and collateralized loan obligations, and all the stuff that you learn about in Big Short. That's all going on in a bigger way in multifamily, because they're even more institutionalized. They're easy to bundle up. You don't have to take a bunch of mortgages. You don't have to take hundreds of mortgages. You need to take 5 or 6 and bundle them up into security.
I will note, we had a nice comment last week from a listener and viewer, Mike Marcus, and he really hit on that idea of banks working with it. He said, the phrase "a rolling loan gathers no loss." I think that kind of succinctly captures the perspective and motivations of lenders, and kind of characterizes a market that's a little bit more realistic than I think people are looking for. Maybe there's just one multifamily owner operator that's going to be in distress, limit that to just one person, and if we just find that guy, then we can find a great deal.
I agree, and there are going to be some of those, and because there will be some situations where the bank's look, this is too far gone. There's nothing we can do here. You either need to come up with some money, but we can't just have us on our books as is. I think there's going to be some of that, but to your point, banks aren't rather not take a loss, and they're hey, if the banks believe things are going to turn around in 6 months to a year, and they've got a good borrower that they would like to continue doing business with, because these are all relationships. It's a competitive market, for clients, and if the bank has an opportunity to help someone out, or take a property away from them, it's a little bit of goodwill to get business down the road. Could be a very good business decision. But outside of the banks, there there are a lot of other options out there for owners that are in distress right now.
And that's what the Globe Street article did mention: mezzanine debt and other kind of capital, pref equity, and stuff like that.
And we've seen a lot of discussions of pref equity and mezz at NMHC, and just in general, a lot of JV equity groups are now, everyone's kind of moving down the or up the capital stack. You know, they're getting in a higher position. You know, whether that's they're doing more first position notes, or a lot of people who are doing common equity are now in pref equity. Some of the pref equity guys are now doing mezz equity, kind of just moving down the risk spectrum, because your yields are on those are typically better right now. You know, mezz debt you're getting probably in the 7 to 9% range. I haven't looked at a mezz debt quote recently because we don't not typically using it. And then pref, again, I haven't looked at pref quote recently either, because we kind of have pref built into the fund. It's at least 10, 12, maybe 14%, depending on all the terms and if it's kind of soft or hard pref equity. But so because in the scenario would be that you have a loan maturing and the value has gone down. You're essentially underwater, but you have to refinance. As you refinance, you have to bring cash to close the loan, to roll the debt, to hold on to the property. And as we talked about, it could be a substantial amount. It could be, it's millions of dollars. It could be almost the size of your initial equity raise. And so if you had a capital call, you'd have to have all of your LPs basically reinvest an amount that they have already contributed. And depending on who you're some investors, that's not a big deal. Others, it's, hey, I don't have that liquid right now. Yeah. But they could go in that scenario. Okay, they can't do the capital call. You could also just go to a pref equity or a mezz shop and basically take on more debt or raise more capital in the form of pref equity. Now that can be dilutive to the rest of the investors, and the return's going to go down to some degree because you're having to bring in more capital in one form or the other that has some rate of return that has to be paid. But it's certainly better than taking a loss on the property. But there's other groups, and I'm seeing this more and more today as more things come in the market, who are seeing this as a possibility that it's going to be tough for them to refinance in 6 months, 8 months. And so they're bringing those deals to market. And to at least to have an option to sell it.
See, that makes a lot more sense than I don't see a lot of people that are going to have their backs against the wall. It is, and this is kind of my response to Mike Marcus was that it may be a factor among many, and the negotiating terms of working with banks may make things a little bit more expensive, so it may just affect their price a little bit. Instead of like a bargain basement, I got to get this thing out the door, it may just be, okay, we're willing to bring our price down just a little bit. It will be one force among many.
Yeah, I mean, there will be some people with their backs against the wall, but yeah, there are enough. There's enough rescue capital out there. There are enough options and off ramps. It's just, but they're all unideal relative to your original return expectations and business plan.
Yeah, and that's actually you did. And what you mentioned is right, and I just wanted to clarify, the Globe Street does mention actually where you'll find it, and it is these situations where they got in a bad situation to begin with, maybe on the wrong side of interest rate movement and or rent growth, and then they have exhausted all of their options, whether banks working with them, whether get pref equity or mezzanine debt or whatever extra financing they can, and they're at the end of the road. And as you get each stage, that winnows the amount of opportunities that are going to be available until maybe you only get a handful that may or may not be findable.
If you bought a 2-cap, 3-cap deal and you needed 30% rent growth in the first year and a half, and you've had flat rent growth or negative rent growth, you're going to be in a bad spot. And we saw those deals. I mean, people who send us those deals. Those deals happen for sure, because people just they're living in the moment. They're like, we're just going to continue to see this for a couple of years without ever moderating. And people spent billions of dollars on those deals. It's not like a one or two. I mean, there was whole portfolios that were bought in that type of environment with those projections on rent growth and low cap rates and short-term debt. So it's they're definitely out there. But how systemic is it? I think we shall see.
And just finally, and this is a little bit different than purely distressed, but in terms of like moving the market again. And I asked you this off the show. This was yesterday, just talking about like, what about the developers that are just going to finish building and bringing things online? Is that going to affect the price? Are they going to have to sell for cheaper, or are they going to wait things out and operate a building when they're not really
if they can
want to?
But that's the hard. I've been talking to developers, and some are in a good spot. I mean, some of them have made so much money over the last couple of years.
They're like, we can just give this one away for free.
I mean, they'd probably be fine. No, but I mean, I was talking to a developer a week or so ago, or last week, and they've built this awesome asset, and its lease up's going great. They wanted to be a long-term holder, and they're looking at a refinance, and just like doesn't look good. I'm like, they could probably roll the debt and be fine and hold on to it. But usually, what you do, the whole idea of the business plan for development is like, you build this thing, you take, you have a bunch of risk at first, and it goes down as you get entitled and zoning. You're building it and you're leasing it up. You lease it up, and you get your NOI to where you want it to go. You've bought it and you've been building it with a short-term floating rate construction loan. Yeah. It's essentially a bridge loan, and you're then going to take it out with a long-term permanent loan if you're going to hold on to it. And that's worked out great, and people have got a big cash out, and you can essentially de-risk the asset at that point, or that's what the goal is. So like, you have $5 million in this development, you're going to refi to your perm loan, and they're going to give you that $5 million back, even more. Maybe they're going to give you back $7 million. So you've taken all the money off the table, you've made some money, you own it. Basically, you're playing with the house's chips. But that's no longer the case. Maybe they can just roll into the new loan but they have to keep all their money in the deal.
Okay.
And so, like, if you have the mindset of like, hey, I'm going to get this money back in 2 or 3 years, now it's like, well, you may have to have it tied up for 10 years. Yeah. It's completely different. And so they're having to decide, okay, is it better just to sell this thing? Like, just get our money back in a smaller return?
And that was my thought, is like, I thought, and this is just based on like random conversations I've had with you, and it's like, I thought that these builders, they'll build it, they'll get it leased up with a bunch of concessions and stuff, just because they want to get the people in there. And then they're like, okay, now we'll take it to someone whose business is operating these things. We're a builder, we don't want to operate.
Well, there's a lot of merchant builders that are like that. Okay. That's the whole model. Not, you can either be a builder and hold on to long term, or and not that people don't do both, but that's a specific model. And some of those guys, like, they may have to hold on longer. And again, some of those guys like that I know, like, again, they've just been so successful over the last couple of years. Like, if they have a big problem, they can probably like write the check themselves, and I'll be good. Yeah. And that's part of another underlying factor is that there has been so much wealth created in the multifamily industry the last 5 or 10 years that, depending on when you got into it, that a lot of these owners, now they may have spent it all, they may have it reinvested, hopefully, but there is certainly the opportunity for individuals to build large cash reserves for a rainy day. Yeah. And they may come at the opportune time for those who have been able to do that. But that doesn't mean everyone has. They could have been very efficient with their capital and gone for the highest return with a high velocity, redeployed it as soon as they got it, which... Looking at a spreadsheet, that makes a lot of sense until you just get into an environment where you just need cash. Yeah. And we've gone so quickly from a cash is trash environment to a cash could be king very soon. Yeah. So it's change in mindset and mentality for a lot of people. But
change of real operations. It's going to be interesting to see how many people. And it does seem like that was another and that was one of the recaps, was like the importance of operations is going to become increasingly.
Yeah, and then that's huge focus. I mean, you've heard me talk about that in just in our property management meetings. There no longer are the days of where you can just get by being like a lazy operator. Yeah, and that's not who we ever have been or wanted to be. But there's a lot of, we buy some of these deals, or you talk to some operators, and it's like they are just doing the bare minimum, it seems like. Yeah. But with cap rate compression and just like organic rent growth, everyone's making a lot of money and seemingly very successful and smart when like they were just buying it and not doing anything. Yep. But now you actually have to. So then you could not even buy that right. You could overpay a little bit. You could be a bad operator and you can make a lot of money. Now you have to be very careful to buy right. You have to finance it right, and you have to operate it like with near flawless precision.
Yeah.
Lowering cost, figuring out how to centralize like your operations.
And
so it's like the difficulty level has gone from like novice to intermediate advanced very quickly.
Yeah, and that's like what I kind of, when I was thinking about this distress and like the landscape, and like what if we never get a huge drop in cap rates? What if it becomes kind of a normal market where like you just have to earn your money? You have to you have to try and get the margins.
Or it comes back to cash flow. All of a sudden you got to like a lot of your returns are going to come from operations. And the way we always used to look at deals was like we looked at the cash flow, and like we're trying to like how quickly can we get double digit cash on cash return so we can get some really good cash flow over the next couple of years, and maybe we refinance it, but we don't even really include that in the model. And the exit was always this like awesome thing that could happen, but like wasn't the goal. It wasn't like how quickly can we get to an exit and just turn it around. Not that there's anything wrong with that. You can make a ton of money doing that, but having a shorter term mindset, I think, can expose some potential risks, and you're not always making the right decisions sometimes. But like it was like, let's look at how much cash flow this thing can generate. But then that quickly went away to just being like, how quickly can we turn this thing around for a big pop and double everybody's money? Because who's going to complain if you can double everybody's money, in a year or two? And again, there's nothing wrong with that. And you find a great opportunity to do that. Like all is good, but that type of business plan is just going to be not an option. Or those early exits, I just don't think are going to be on the table nearly as frequently as they once were. And some of the buyers who have bought recently are still in that quick turn mindset, and who have used these short-term bridge loans in this environment and are now hoping that they can still eke out a return by turning around and selling it after they bought it last year, and now they're going to go to sell it because they're like, we're not going to be able to refinance this thing, and like, might as well give it a shot.
Yeah.
There's a sucker out there. The brokers are convinced. The brokers are convinced there are still some buyers out there. Because in the number there are, but the number's getting smaller and smaller and smaller. Who are just like they need to place some capital. It's like a 1031 buyer.
Yeah.
Which they're just waiting for that one unicorn to come in and overpay, because there historically always has been, but like, man, their numbers are dwindling.
And the difference is, and I was thinking about this too. Is this like it was the wait and see early pandemic era where people were waiting for deals that didn't come? The difference is interest rates. Back then, it was easier to make the math work.
Yeah.
And now you can't make the math work.
It's just a different environment too, because like in the pandemic, like everyone went home with their like families and for like a month or two or whatever. And that's not really what we did, but like, well, we went home with our family, but it was like you wanted to do work, you couldn't do work, and so it was just like everyone was like drinking at home and like whatever we were doing, and we were buying deals, but now that's not the case anymore. The similarity is like the market is like partially frozen, but it's like more like everyone's like waiting in like a trench, like ready to go, waiting for like the whistle, and to get like either like run to victory or just get like annihilated. And everyone's just like
that was my other thing that I wrote is who is going to be the first person over. This is exactly what I was thinking of.
The trench.
I was thinking of the medieval war metaphor. The first person over the wall that gets shot by the archers. Who's going to be that first person?
You're either shot over, either immediately shot or stabbed,
or they skip you.
You go third, you knock everybody out, and you take the castle, and you raise the flag.
So I wonder who are those first individuals going to be, and God bless them.
Cannon fodder, or tip of the spear. There's going to be some pioneers out there, and I've learned in previous ventures that pioneers are awesome, but also the ones that get like the arrows in the back and can get beat up. But it also there's also the time when you have to move when no one else is moving. And again, like that's what we did in COVID when things were like, okay, we feel much more comfortable about this situation. We're buying at good prices. No, just the market's quiet. We're like the only buyers here, so we can get a great deal. I think that's still going to be the case. But just like you can't just have the mindset of like we're going to buy anything. You just have to be like much more discerning and again like way we're looking at it is, okay, well, what does it cost to build this? Especially when we're looking at like newer stuff or like newish stuff, right? How much it would cost us like to build this brand new? And if we can buy from like a significant, like, 20, and it depends on how old the asset is, but like, let's say we're looking at like a, early mid 2000s asset. Okay. So it's going to cost like, maybe, $215 to $245 to build per unit to build something new in the Midwest, maybe up to $250, but probably I'll call it like $220.
Okay.
And that's like, a general guess talking to developers and stuff.
Yeah.
So if you can buy something for that's maybe a little bit older, but if you can buy it for like $160 or $170 a door, I mean, and you can get rents that are somewhat similar to that. Like, I think that makes a lot of sense if you look at your returns and they're attractive.
Yeah.
They're paying more than what, you can get out of treasuries and, and you have some potential upside using a conservative exit cap rate. Like we're using, like 6 now more than anything, maybe 6.5, still looking at like all the way up to like 7.5, but like, where we had been using, 5.5 to 5, well, really 5.25 up to 6. Now it's like, we're closer to 6 and even above 6. So if that all looks good on, reasonable assumptions on an exit, reasonable rent growth that like we know is going on, not just has happened in the market, but like is expected with reasonable assumptions to continue to grow. Okay, we think that makes a lot of sense. But if you're buying something like, there's a lot of deals that have been on the market, newer product that have been $250, $275, almost $300 a unit. But if you can build it for $230, what's the point?
Yeah.
Now there's risk in building it, but like there ain't going to be much to squeeze there, like, at all. And where people were just taking a flyer on those, there's just so much new product that's going to be coming out that like you got to just be buying below replacement costs.
Yeah. And that's why I think people have avoided Class A or at least that's what I've heard is like avoid Class A because there's so many new ones coming up, and those are usually the Class A that get built. But if there's a market where they're not building any Class A, then look at it.
Exactly. And then all of a sudden that can be a big opportunity because all of a sudden like, no one's looking for Class A, but then you find a market that's like, well, no, they really haven't built that much.
Yeah.
And this actually is needed in the right spot. And okay, and so then we're looking at a deal not too different from that description, and it's like, okay, well, this is what it would cost to, what number, but they both have to be true. That we have to be below what it would cost us to build it, and returns that we can get excited about. Yeah. And if that's our offer, and that doesn't work, then that's fine. I mean, maybe we're within a range, but that's where it's got to be, and some of those will happen, some of those won't. It's going to be, it's going to come up to the seller and what their personal financial situation is like, what their portfolio looks like, how motivated they are, and we've got some deals in the pipeline that we're really excited about that are just one-off situations where we're solving some problems for some owners, or we're just kind of helping them restructure some things, but it's a big win for us because it's going to turn into an acquisition. Yeah. But some people are going to hold out to the end, and some people aren't good business people, and they're not going to communicate with anyone, and it'll get ugly for a few. Yeah. Yeah.
That's operations.
Yep. All right. Let's talk about where do you want to go to, Matt?
Let's go back to being a good landlord, having good operations.
Okay. Oh yeah. This is good. This is good. So there's a bill that's working its way through the Indiana General Assembly. They just passed the Indiana House. It's gonna attempt to hold landlords accountable. So, Matt, I want to get your take on this, but I just first want to say two things really bug me. One is government sticking their nose in where it doesn't belong, getting in the way of how markets should work. But the second thing is bad landlords who just neglect their properties.
Yeah, you got to be.
I don't know what grinds my gears more. Yeah. So this one, it's kind of addressing kind of both of those, but I don't know. But I want to hear your take. See if I can get behind this, or if it's just more government
I think that's
overreach.
true. The first thing I thought of was that Indiana is usually among the top listed of landlord-friendly states, and we're a red state, and so something like this is surprising to see. To be frank,
and it got it passed. It got a committee unanimously,
and
that means there's a lot of there's a lot of Republican support.
And the second thing I'm thinking, well, if they're making rules against it, are they rules against you can't have like a pigsty in the middle of your living room, and have renters live right next door to it or something like that, you can't have ridiculous
the real
things.
Problems facing the nation.
But and you actually know a little bit more of the details of what may have kind of motivated this, but
there was an apartment community on the north side of Indianapolis that was owned and operated by a nonprofit, and it was an infamous. I mean, it was like newspaper articles once a month. The clubhouse burned down, and nothing was ever being repaired, and just like roofs falling in, and then the owner wasn't paying like their utility bills. People's utilities were getting shut off. When they were the tenants were paying theirs, but the landlord wasn't paying theirs, and so it was just a complete mess. The city was trying to move to foreclose on the property, but then the property was sold secretively, before the city could do anything. So this is I think this is inspired specifically from that instance, but it was just another example, because it's not the only property that's being neglected. I mean, we've bought properties that you go in and you're like, this is a multi-million-dollar asset.
Yeah.
How do you just not care? How do you not care about one, people who live there? You're not providing them livable conditions. One as from a human perspective.
Yeah.
But because they're your customers.
Yeah.
But then just from a economic standpoint, it's not good. It's not good business.
It's like corporate depression. You can't get out of bed in the morning. You're shooting yourself in the foot.
Yeah. I hate out-of-state landlords. Again, not to disparage any of the fine folks from New York City, but we've got a lot of owners from New York, and I'd say from LA also, but a lot of these guys from New York that come in, they just buy properties they see it as cheap. They see it's the Midwest is going to be cheap. They buy it, they don't put any money into it, and they get some cash flow, and then they sell with some cap rate compression, and they just run it into the ground.
Yeah.
They instead of adding value, they extract. They're literally they're extracting value from the property, the community,
and this may
and
be
the industry.
This may be rose-colored glasses to me to think this, but I think if you take a little bit of attention, it gets easier. And if you start letting things slip, you're going to create things that are going to get harder for you, and it's less efficient. Things like the problem they're talking about right now is 45 days of a written notice if there's a serious problem. And they actually say, because I thought, well, what is this, a squeaky door that you have to have 45 days? If you make a reasonable written interrogatory, is the language of the bill, you have 45 days, the landlord has 45 days to respond to that, or the government's going to be knocking on their door.
And doing what?
Taking over, perhaps.
What? So if it is a squeaky, so I'd be curious. I haven't read the text of the bill, but is it a dollar amount? Because what if the light bulb? I need to change the light bulb. I give a written notice. Now you should change the light bulb, but they can foreclose on the property, or
I'm not sure exactly.
Or maybe they can put a lien on it. Maybe they can put a lien on the property.
So there's some quotes. I didn't read the entire bill, but then the coverage of the bill said there was a representative that quoted Justin Moed, who says that the Attorney General can intervene early and try to ask a judge to make sure that we set aside funds to pay the bills to make sure that people's homes are preserved and that they are not put out on the street.
Yeah.
Again, adequately run properties, this is fine. This is for places where, I'm not kidding, where it's you just stopped caring, and you're worse off too.
Yeah.
And
it's for the worst of the worst landlords. The concern is always with this is the unintended consequences.
Yeah,
and the law being used not for the worst of the worst landlords, but for just people who are trying to get out of a lease.
Call you at 3 a.m. and say, I've called you for 45 days about my squeaky laundry door. Now I'm going to get the government involved. I'm hoping that isn't used for that.
Yeah, because
my light's flickering when it's not flickering. You are just crazy.
Yeah. No, and or let's say there's it's a, I don't know, there's a part that like you're
that's a good
like
point.
washing your dryer, like there's a part, and we're told it's going to come in 30 days, and then like ends up taking 45 days. And we think that we tell the resident, hey, it should be here in 30 days, we'll fix it. But then 45, it's on the 46th day, it comes in, and whatever the case. There are some reasonable things. Now you could argue you should just replace it, and it probably would be the right move. But I'm just saying, there could be an operator or a landlord, and again, a lot of these decisions are made by on-site staff of, and some of them, the priorities and budgets of the management and ownership, they get a lot of the intent gets lost in the message.
And another, this was classified under nonprofit, so this may not apply to market rate, but I'm not. I'm going to have to reread this bill. It was another thing about this bill. It wasn't explicitly labeled as a tenants' rights bill. It was labeled as a nonprofit bill. But that's maybe
because the owner, of the community in question, this infamous community, was a nonprofit organization that was in the affordable housing space, which is there could probably be an entire piece written on the amazing actors and owners in the nonprofit space, and the folks that are not amazing, because you say, well, they're nonprofit. Well, they are making money because they're charging exorbitantly high management fees that their operating company, which may or may not be for profit, is making.
And what I am thinking about too is if this does extend to market, if there are unintended consequences, the procedures that now a good operator should have. Maybe now, if someone makes a complaint, you get a paper trail on that, and so that you can email them back or somehow have like a recorded correspondence to show that you have responded to their inquiry within the 45-day window, and you're working.
Yeah, well, and all that should already be taking place. I mean, like when people put work orders in, it all gets logged, and it's scheduled and tracked, and like so all that should be being communicated. Now things get dropped, and things always don't. It's all. The outputs are as good as the inputs, right? But from service level, not having read the however long the bill is in its entirely, I'd say it's not a big deal for your general apartment owner in the state of Indiana. But I think it's something good that we need to watch and see what some of the discussions and the actual text of the bill to see. If there could be any unintended consequences, from this, or just something you just needed to keep an eye out. For. So, good stuff.
For sure.
All right.
Let's zoom out. Let's zoom out as far as we can to the entire economy of the United States.
Okay.
So, we had last week a big jobs report. Pretty dang big. 2.5 times as big as expected. Doesn't smell I'm going to talk about it.
Yeah, it doesn't smell like a recession just yet, man.
And now, if you want to keep thinking about this as good news and not as the inverted way where it's just more fuel for inflation and therefore interest rate increases, you can kind of maybe justify your optimism by thinking about the relatively slow wage growth, which at 0.3% month over month is lower than inflation, although 3.6% annualized is still a little bit high. It's higher than the target, 2%. But still, jobs without significant wage growth. What could be better?
That's a little bit of a silver lining because, to your point, it's certainly not going to tell the Federal Reserve that they can take their foot off, the brakes of slowing the economy. Because they're saying, hey, we got room to move, and we're certainly not going to pivot right now. Because this could potentially be inflationary. And we don't see any signs of stress that warrant it. If jobs are being created, and this does, I think, fly in the face of some of the, again, the headlines of all the tech layoffs, because it's like, well, okay, there are layoffs going on, and we're seeing some outside the tech industry, but net, we gained 500,000 jobs.
And I think some of the story is what I've heard is that it's a little bit due to the return of the service economy. I think that is a big deal, but I do think you can focus on all these layoffs from places like Dell or Salesforce or whatever, but the larger economy is doing pretty well. I have actually also, there was another article, I'll just summarize it very quickly, that said like maybe we're thinking about the Phillips curve all wrong, and maybe it's not the fact that I've been reading some about just is the Phillips curve just like now? I don't know. I'm still a little bit skeptical of those takes, like of a of a pure take like that. I think maybe you can come up with an argument that might be true in some cases, but I would be a little bit. I feel like there's some.
Yeah, I don't think that that the story has fully been written yet, and I think that could be the case. That could be a good point. I think that's worth considering and assessing whether that is true or not. But also again, this is why I'm like it's just too early to say. Yeah. I mean, the peak unemployment during a recession almost always happens like right after the recession is over. Now, typically, unemployment is rising during that period, but it basically goes. I mean, it goes from very low unemployment then spiking up. We haven't seen any spike up, but usually that's triggered by a handful of cascading economic realities or headlines or events that throws it over the ledge, and we just have not seen that. And again, what is that right now? The momentum is towards like the economy's looking pretty good as inflation is cooling down, and we still have people that are employed. And
I mean, you can find, if you're looking for bad things, you can find them
always.
Like,
but I think we're just convinced. Again, we've talked about this before, but just it's like we people just feel like we need a recession. Like, how do we get out of a recession? You look at the yield curve. You just look at things go up, then they go down. We have to have a reversion to the mean. And we have in many asset classes in many ways, which is why this has been hard to be like, what type of environment is this? We had negative GDP growth 2 quarters last year, and record high inflation, and so we've got really high government deficits, and we've got a war in Europe, all this stuff. But
and one thing I was talking to you before about that it was a little bit interesting and gave me some context is I looked at the personal savings rate, because that's another thing that you hear and lots of talk about the economy is like, oh yeah, well, all that savings that people had built up during the pandemic, that's all gone now, and it is gone, and they are drawing down and down and down. Well, it kind of is true. It reached its low point in September of last year. So that story has not really changed. I'm sorry, it has become a different story since September. On October, or I'm sorry, in June, July, August, yes, things were going down. But now things are kind of staying the same when it comes to spending. Maybe even going up a little bit when it comes to saving, actually.
I mean, they're half of what they were pre-pandemic, I'd say.
Oh, it is low. But I also think that the reason why the savings is low is because it was so high earlier, and it may be some kind of reaction, a little bit of a bounce back or ripple effect because it was so high during 2020, 2021.
I would have expected it to land in the similar levels that we were seeing, pre-pandemic in 2019. But I mean, it's really, it was in the we were in the 7 to 9% range, or call it 6 to 9% range percent of a personal savings rate. We're down to the 2.5, 2.9. I think the difference is in this gap has got to be inflation, though. It's like they're spending X, and they were able to put a little bit in, but that that excess couple basis, that 3 to 6 basis points, has gone into higher costs.
Yeah. And consumer sentiment generally is ain't so great.
No, but to your point, Matt, right before this, as of recently, inflation has notably come down, and there's some bright spots. It has ticked up, since as you said, bottomed out in September 22, but we've inched up slightly. We're now at 3.4, where we were at a low point of 2.4. So I mean,
we're trending up.
But it's too early. And again,
and it is still quite low.
It's quite low, and there's a handful of trends that are promising. I mean, we're seeing, again, this is all very high frequency, too early, not enough trend, but we're getting better traffic across our multifamily portfolio. We're getting good traffic.
That's great.
Now, as a nation, we didn't. There's often a little bit of a bounce in January. We didn't see a bounce in occupancy or rent growth in January. Sometimes you do. People, get back from the new year. Got to do something. But we've seen. But there has been national and just again our personal anecdotal experience of higher traffic compared to November and December, which are always historically and seasonally slow months. They were extra slow, and months prior were slower than normal, but we're seeing some decent signs, and I also think there's a renter psychology of people are starting to kind of come to terms with where new rental rates are, where it was a little bit of a shock last year, but now it's like they're like, yeah, everywhere is that expensive.
Yep.
So.
Yeah. In all, like, and to kind of continue bringing this back to multifamily, this is a macroeconomic, we're talking about unemployment, but it builds the economy that our renters are dealing with, that we are going to be dealing with, that is going to act as a signal perhaps to Jerome Powell, and the contours of this employment situation, whether there's wage growth, whether the people at the Fed feel like it's going to contribute to inflation, that's going to affect interest rates.
Yeah.
But in all, if you're talking about the economy or whether it's recession or whatever, the immediate conditions right now, it's like unalloyed good. The unemployment rate is as low as it has been since 1965, and I looked for a qualifier there. I was like, maybe there's something that's people talk about labor force participation as something that might undercut it, but really, labor force participation is looking good too. The full labor force participation rate, if you look at it, that kind of almost like tracks baby boomers. This is not as accurate as the 25 to 54 labor force participation rate.
I'm really glad that you included this, Matt, because I mean, people are like, why are the participation rate so low? People aren't working. It's like, it's, I think, a pretty simple answer, and it's baby boomers.
Yeah.
They're retiring.
And you can see the labor, if you look at the full one too, it was low in 1960 when the baby boomers were still young. But then once they started getting jobs, it goes up, and now as they're getting older, it's starting to go down again. And
there's also the gap of, and this wouldn't affect this, 25 to 54 range because they were never included. But, again, there's that, Marcus and Millichap put out a piece of research in their outlook of saying that, we've got about 3 million individuals in the kind of the 18 to 34 age demographic cohort that, still live at home with their parents.
Yeah.
3 million more over the historical average.
Yeah. Wow.
And so, now we've got a lot of people in the United States, a lot of working, but I'm assuming a lot of those individuals also maybe aren't working. Yeah. Or a big chunk of them.
Yeah. Yeah.
And then also the fact that, during the pandemic, a lot of people decided, whether it was, a husband or a wife decided they were going to work from home, be a stay-at-home, mom or dad. And I'm just like, hey, I'm going to be working part-time and doing stuff of my own, going out and starting a business, a lot of businesses were started.
Yeah.
So there's a lot of different factors, but I think that this is putting it in context of like, no, we are really back to the, decently high labor participation rates in the individuals that are in the core labor demographic. It's just all the baby boomers are checking out early, which is clear. They worked hard. It's fine.
Yeah, and it's clear if you look at the full one that the pandemic was like the jolt that a lot of
of that population. I'm just like, I'm done.
Yeah.
I am done.
I don't blame him.
Yeah, no, I don't. Now, what'll be interesting is if with the markets being down and who knows if some people have to re-enter the labor market. I think that's on the margins, because also your portfolio may be down in the short term, your retirement savings, but also the ability to generate income has been much easier. So you can actually generate, almost more at the same income with almost just half, or if you have 60% of your portfolio, if yields are double, you're in a decent spot. In terms of like income, now if you're like paring back and if your plan for income is to sell, then it's not as good, because you have to sell more than you thought.
Interesting.
But but so people are on the edge, or it's going to be tough and they're going to be in squeeze. But to your point, Matt, it's not really as bad of a dire situation as we thought, but this also goes to show that it's not like there's so much slack in the labor market from people who aren't working. There's obviously there is some, but it's we are back to 2019 levels in terms of the labor participation rate. Wasn't it had been going down a little bit since 2000, but it was a pretty strong bounce back. I mean, we're basically in January. We're at basically October 2019 levels.
Yeah. And that's where I wonder, again, about wage growth.
Yeah.
And where,
Where people are going to come from.
We didn't. Yeah, like if there's a lot of job listings, not a lot of job seekers, then you'd think that prices would go up. Now, the only thing I think that is, like you said, it's this perception of upcoming recession that may, and I've heard a lot of this job growth is from corporations holding on to their employees because they want to fire them and have to hire someone else in the new market, and they're kind of uncertain about what's going to come. Maybe there is going to be a recession online, but maybe there's not. But they're just kind of holding on and waiting.
Yeah.
Very strange.
Well, and I think there's a lot of people and businesses that are focused on fighting the last war, whether that's inflation or supply chain challenges of, now like we didn't have enough product, so we ordered a bunch of product.
Yeah.
Now we've got too much product, and so there's been a lot of zip, zap, and back. And
well,
forth,
and that's what
one step forward.
That's what Jerome Powell. I felt like a subtext for Powell's comments, and we can get into them if you want to. Was that we are transitioning from a goods economy and moving a little bit more, putting services back in, and so goods is very disinflationary, and that's the headline is the Fed chair says disinflationary process has begun in the U.S. economy, and I want to say like a disinflationary process, not like a general one, but like there are certain areas that are
theirs their goal of a deflationary process. Is ongoing. I mean, I think that's it's a good sign. I think this could be falsely taken from the markets as like, okay, we're getting ready for like a Fed pivot, and I think I'm much more in the camp of like, I think they're just going to hang out for a while. Like there are a lot of, again, back to NMHC, a lot of brokers, a lot of people are telling me like, hey, rates are going to be way lower near the end of the year. I'm like, well, are they? I don't know. And the cap rates are going to go back down. And I'm like, I can see like things improving significantly by the end of the year, but I don't think it's not going to be because cap rates are going to go down. And I only think that, and now that they couldn't go back down again, like if it's like Goldilocks, everyone just jumps back into the market and it's a feeding front. That could happen. Only a couple of deals, but it's just the market is such a slow moving boat. Like it's a it's a big boat.
Yeah.
And like it's slow to adapt and slow to move, which you can have an opportunity if you are, living in one market and real estate's in another place. Like we were in 2021 where, rates were, in the 2% range, but cap rates were, they were low, but like we had really good rates of growth, but the debt was really cheap. We just got so much momentum with declining prices and expanding cap rates, like the fact that it's not going to just turn on a dime. Not that like things can't get better in like a medium term, but we're only in February, right? But like it's in terms of real estate deals, again, remember real estate deals take like a decent amount of time, like a quarter to complete from like when you get the deal to when it closes. I mean, technically 60 days, but like it's usually like 120 days for the whole process. Just like be prepared for that. So like there's only so much pricing activity and price discovery that can happen over that period of time. Like it takes a whole quarter from like you agree on a price when you close on it. Yeah. So I just don't see cap rates like coming down that quickly. Yeah, that's a good point. Again, the boat, like you can start to turn the boat, but I mean it's not even like an aircraft carrier that can go like 40 knots and like actually is maneuverable. We're talking like more like cruise ship, oil tanker situation. Like it's running at like 8 knots and like the bow thruster is from the 70s and
people are waiting for that tugboat, but it ain't coming.
Exactly. You got to bring a freaking tugboat in. Like the Fed's got to come in or somebody's got to come in next to the tugboat.
So I think that I think you're spot on about rate increases. I think that the Fed, at least that's my speculation, from reading from these comments here, he didn't say like, oh, we're actually really scared now, which would mean maybe we're seeing another 1%. I think we're going to get another quarter or 25 basis point rate increases. I think we may be there may be a point where we're flat at the year and not increasing or decreasing. But what was interesting is the comments both inside the body of this article and in the comments section, which I love. They were all like,
go to the comments.
The Fed is blind. I can't believe the Fed should have been reading this jobs report, and their next rate increase should be 1 or 2%. This is ridiculous.
Just kill it. Just kill the economy.
And that's the quote. That's the quote from one of the the body of the article says, this economist called Powell's thinking a stale outlook, and he said that he had an opportunity to lean against the jobs report, and he took a pass. And yeah, all the commenters are saying that too. They're like, "Boo! Give us more rate hikes. We want more eggs, cheap eggs."
Yeah.
I think
omelets.
that every time someone complains more about eggs, I'm just gonna add one more egg to my omelet. I'm
Matt,
sick of hearing about all these eggs.
I heard Taylor Swift was receiving flack from not responding correctly to a joke at the Grammys about eggs. She's out of touch.
Do you know what that Chinese balloon was full of?
Eggs.
Eggs. I can't believe it. That's where they all went.
That's a psychological warfare right there.
Oh man, I can't believe it.
As we progress.
Sorry.
Matt, these comments on Yahoo Finance are great. It's always fun hearing what people have to say.
Yeah.
Some real gems in here. This person learned the hard way. Fed government is not going to let American financially collapse and accept the pain to correct. That's kind of true. Unfortunately, the loss of the world currency dollar and unimaginable $31 trillion of debt may force that pain to finally happen. This year is going to be a wild ride. Best of all.
That's all.
Good luck, everybody.
They're not pulling their punches.
No. There's a lot of people. I think people just in general are more keyed into economics and macroeconomics than they were. I mean, I think just the fact that everyone's talking about interest rates and inflation, and they're closer to the capital markets because maybe they got a mortgage and they bought a house recently. But people, I think, are much more cued into monetary policy, and I think that's a good thing over the long run.
And this is part of the the discussion that I.
Is just the politics continue to creep further into the Federal Reserve, which is a whole other discussion. And it's because of the relationship, but we have a central bank and centralized monetary system. There are some weaknesses in that, and so that's the only downside. It is good people are into it and are knowledgeable and have an opinion, but then that's more political pressure on the institution that's supposed to be completely apolitical.
And what I think is I think it's inflation that may get because this is grocery prices, and you're like, why are they high? Oh, it's because of these low interest rates. And they're kind of tracing it back to the prime cause. And I was thinking about this, and again, I mentioned there are people that don't believe in the Phillips curve, or there are people that say, actually we should not worry so much about inflation right now. We should lower these rates before it causes a recession and affects
It's
employment.
messing up my deals, man.
Yeah. It's messing up deals, but also a lot of I think it's kind of the left-leaning left-leaning perspective think that let's lower rates, and the problem of employment is a lot more keenly felt than maybe the threat of inflation. But I don't know. To me, inflation could get wildly out of control. It seems like you cause a recession, you kind of have a tool. Maybe you can lower rates and you can get it back. But if it's inflation, maybe you get to this point where not only is there inflation, but then you're gonna have to solve that too. So you bring on stagflation and you get both. It's like you're teetering here, and then if you get a little bit too much, you can lean so hard into inflation.
I mean, because picture an environment imagine a world that is like today, but instead of Fed tightening, the Fed was loosening or didn't do anything. And in tech companies, instead of laying off now, they're going to, let's say that the tech companies, the Fed pivoted today, and then the tech companies, they get better valuations because, so they dropped Fed funds rate way back down for whatever. I don't know why there would have to be a reason, but let's say they did, all of a sudden people have more money. What are they going to do? They're going to start spending more money, and which creates more jobs. And we're going to have the tech companies are going to have an extra couple $1 billion to go hire another couple thousand people who are being paid $500,000 a year or whatever. And so everyone starts spending money again, and what do we think is gonna happen?
That's why it's almost like recession the recession equation doesn't. There is a psychological element. I can't discount that. But like that seems like a more controllable thing. Whereas the psychology of inflation, you could just get like the Hulk gets madder and madder, gets stronger and stronger. That's how inflation could be.
Yeah. And you have to all of a sudden. I mean, you can feel the pressures now on people. And I'm just having some conversations with investors of like, hey, I got to get this money to work. You got to spend it because it's being devalued every single day. And especially if you have a lot of capital sitting on the sidelines, it's like, I got to get this to work.
Yeah.
Like I'm losing 7%. Now maybe you're getting 3 or 4% in a money market account, but you're still losing, a couple basis points depending on whatever inflation is. So. You can get in that spiral of just again higher velocity money just makes things grow, but if out of whack in a sense that you could have some crazy form of hyperinflation. There's other places in the world. I mean, go down to Argentina, see what it's like, or Venezuela.
That's why I think that I don't. Where like the job of the Fed, yes, they have those mandates, but like the tools they have is. One of them is communication and making sure this psychological element and making sure, and they're going to overshoot on rate hikes because they don't want to get that psychology wrong and make people think, oh no, they're going to ease up soon. Like
they're building up their credibility. They want to be taken seriously.
Yeah, exactly.
And also, if there's a recession, what will be really interesting if there's a recession, what do they do? Because is the playbook different from last time?
Yeah.
The playbook last couple crises, it was easy. You lower rates.
Yeah.
Are they going to feel confident enough that inflation is in check to lower those rates? But maybe there's some moderation, middle ground. Maybe they're not raising them to zero. Maybe they're just easing off.
Yeah.
It doesn't have to be maybe so extreme and binary.
Yeah.
Maybe if we see some actual economic true headwinds and we're seeing mass layoffs, we actually have negative unemployment growth. Real job losses. Maybe they loosen 25. If they loosened, they could raise it 25 basis points and then lower it 5, and people would just go nuts.
Oh, for sure.
The idea of it.
Yeah, exactly. Yeah.
So it's going to be interesting to see what they're going to do, and everyone's a Fed watcher these days.
Heavy lies the crown, Jerome Powell. I would not envy you. I do not envy you.
Do you know how much money Jerome Powell makes?
No.
He did an interview recently. I think it was with David Rubenstein, and he makes $190,000 a year.
God bless him.
And he asked him, "Do you think that's appropriate compensation for a Fed governor or Fed chairman?" And he said, "Yeah, I do." And everyone literally laughed.
Everyone laughed
because the guy's got a lot of responsibility, and again, that's like decent money. But
do you think anyone's taking him out to dinner and trying to influence opinion?
Well, it certainly opens up. It just it says a lot of things. One, it's like only rich need
exactly.
apply.
Yeah.
For if you've got that type of skill set, so it's like you're eliminating all the people who are really smart, but like they haven't already made it.
Yeah.
Or you're opening it up to potential corruption, whether it's out of the job, for the job, during the job.
Yeah.
But you're just not attracting. How are you going to attract? I don't think anyone would be upset if he was making $10 million a year.
Yeah. Corporations would love to fund that.
What percent? The amount of money that the Fed is creating.
I know.
And managing,
yeah.
He can take fractions of a BIP, and there's many zeros behind that.
If you could lobby the Fed,
it can make the money.
Don't you think that people would spend $10 million? Yeah. Maybe people are taking him out to dinner. I hope so. He's hungry too. He eats.
He's got to eat with people, business leaders in the economy.
That's right.
See what's going on.
Yeah.
Now, are you gonna be swayed by dinners? I don't know. Now, if the Fed chairman all of a sudden was hanging out on super yachts. Maybe, or showing up in FTX commercials. But then there was all the controversy of the last year and a half of different Fed governors and Fed board members who were trading stocks, and if they're only making, and again, $200,000 is a lot of money, but their colleagues in the private practice are taking home many more, two more zeros usually.
Maybe we can just get an algorithm to do it.
Yeah. I don't know. I mean, well, beyond the scope of this discussion.
Yeah.
And Matt, I am running into a
sorry.
little bit of a
I kept you.
stop that is quite hard.
All right.
What else is there?
No, this is all. This is it.
This has been awesome.
Yeah.
So if you find this conversation like remotely tangentially interesting, you're going to want to be a subscriber if you're not already. So check out the Great Capital YouTube channel. Comes as a podcast too. So you're like, I'm working out, I'm in the car, I can't watch the video. It is an audio format directly into the brain. There's other ways you can get in touch with us, though. I mean, the Gray Report, what's a newsletter? It's a website. You can go to grayreport.com. You can sign up for it there. Check out, we got all these articles and like many times more articles than this on the Gray Report. And then just the newsletter. I mean, the newsletter just keeps getting like the praise that keeps coming in from on high. I mean, we didn't even get to talk about my conversation with John Chang. I had it on MHC.
Yeah.
We feature on all the time, and he's a fan of what we're doing here, or he's at least familiar.
We got to talk about that next week.
Yeah, we got to talk about that next week because I got some answers to some questions.
Yeah. Forgot about that.
But yeah, I mean, is it the the sextant of the multifamily operator of today? Navigating the high seas. I'm not going to say that it isn't. Okay. It maybe it is. It maybe it's like a GPS. I mean,
we're
like
the Antikythera mechanism.
We'll learn what that means, what it is. But it's one of those if you know, you know.
Yeah.
And I take great pride and I'm humbled when I look at who's on our subscriber list. Not who's on our subscriber list, but like who is like opening all the emails.
Yeah.
Who's reading it, and who's clicking on a lot of links because we can see. We can see who's clicking on links. We've got the technology. We've had it for a while.
We love everyone.
We love everyone. It's true. Not a lot of unsubscribes, Matt. We're like when we look at the benchmarks, they're like you guys are like no. Everyone likes. I mean, we get some people who are like I meant to subscribe to multi farming news in the Quad County region, and I made a mistake. So check us out. GreatCapitalLLC.com, though. That's where if you're like, I'm an accredited investor and I want to hop on the Great Capital train and make some cash flow and with some very reasonable priced and well-structured investments that, I don't know, we're proud of. We're fully subscribed now for our latest deal, so we're all good. But we've got other deals that are going to be coming down the pipeline. Some we're working on, some new loan assumptions. They're just... I didn't know if we were going to get many deals done this year, but some of these, again, I can't get all the details, but people are feeling nervous and they are coming to us first off market and being like, hey, can you guys help us work something out, which is really cool.
For sure.
And we're able to give them a great opportunity to maybe restructure while we get to come in, great basis, great opportunity, and create win-win situations. That's what we're all about. Like, let's create the win-win, no zero-sum mentality. So appreciate you watching this. It means a lot. Matt, thanks for putting together another great episode. We'll catch you all on the flip side in another excellent episode of The Gray Report. Catch you next week.